And I feel it's necessary for me to highlight the disadvantages or the dark side of fixed income impact investing. While fixed income impact investing has many advantages, it also presents certain disadvantages. And so here are some key drawbacks or pitfalls to consider. Number one is lower returns. A fixed income investment generally offer lower potential returns compared to equities, which might deter some investors seeking higher returns. In actual fact, if your desire is to obtain higher returns, then you shouldn't be investing in a fixed income impact investing because the return is inherently quite low compared to traditional investing. Number two is interest rate risk. Fixed income securities are sensitive to interest rate fluctuations. And so, rising interest rates can lead to a decline in bond price, affecting the overall value of the investor. We all know that there's that inverse relationship, that inverse correlation between interest rates and bond prices. When interest rates, rises, bond prices will typically drop. And this particular phenomenon will also affect you as a fixed income impact investor. Number three is credit risk. There is a risk that issuers of fixed income securities may default on their obligations. They may not be able to pay the coupon as at when due, particularly in impact-focused investments that may involve, higher risk project or startup. The more the risk level of the commitments you are getting involved in, the company you are getting involved in, then of course the higher, the level of credit risk in that particular investment. So you must take this into consideration. Number four is limited liquidity. Some fixed income impact investments may have lower liquidity compared to more traditional fixed income options, making it harder to sell them in the secondary market. When it comes to investing, we should not forget the liquidity factor. In other words, can you very easily dispose your holdings? How easy is it for you to, will it be for you to sell your shares, as the case may be? If it's not very easy, that means that there is no sufficient liquidity in that investments. And so when it becomes necessary for you to sell, you may face difficulty, finding a willing buyer. Number five is impact dilution. So as with other impact investments, there is a risk that intended, social or environmental impacts may be diluted over time, particularly if financial performance becomes the primary focus. Generally, people may start with that idealistic goal of creating impact, but as time goes on, there may be this diversion from the impact, creation objectives into a more, financial kind of objective. They want to obtain significant financial returns, and that may not really go well with the initial goal of, going into impact investing. Number six is greenwashing. Greenwashing. Some issuers, may exaggerate their impact claims or engage in greenwashing, making it difficult for investors to identify truly impactful investment. There's that tendency to exaggerate the impact of the investments There could be even, a clear, obvious misrepresentation, misinformation, and even outright lies, deception when it comes to this particular class of investing. And this concept is called greenwashing. And you should be mindful of this phenomenon because it happens, quite a lot when it comes to impactful investments. Please subscribe to this channel and like this video if you've not done that. Number 7 is inconsistent impact measurement. Inconsistent impact measurement. The lack of standardized metrics for measuring impacts can complicate assessment and comparison, leading to uncertainty about the effectiveness of investments. So, how do you adequately analyze or assess critically the impacts this investment is actually doing, accomplishing, in the community or the environment involved? Sometimes it might be difficult to be able to fully assess the impact because of a lack of standard procedure in measuring the impacts of these investments. Number 8 is market competition. Market competition. As demand for impact investment grows, competition for high quality fixed income opportunities may increase, potentially driving down returns. Whenever there's a prospect, investors may pile in, and as they pile in, they create a kind of competitive atmosphere. And once the atmosphere becomes competitive, there's that tendency that there could be overvaluation in asset prices, and then that would cause valuation to increase. And once valuation increases and you buy at a higher value, it will invariably, eat into your eventual profit when it is time for you to dispose your holding. Number 9 is regulatory and policy risk. Changes in regulations or government policies related to sustainability or impact investing can create uncertainty that affects investment performance. They rightly say that change is the only constant. You discover that you keep on coming across changes in government policy and regulation, and these changes sometimes may affect an investment positively, and sometimes it may affect an investment negatively. And so it might drive down your expected returns at the end of the day. And so you have to be very mindful of regulation and policies as they come, and you weigh their impacts on the investments you've undertaken. Number 10 is longer investment horizons. And many fixed income impact investments may have longer maturities, which could tie up capital for extended periods and limit investment opportunity or limit investment flexibility. When it comes to these, fixed income impact investing, you are there for the long haul. You are there for the long term, and so if you come in with a short-term mentality, then definitely you will not be able to really make it because, you could get your capital tied down for a long duration, and that will not really go well with you if you have a short-term mentality or a short-term mindset. The disadvantages underscores the need for thorough due diligence and careful consideration when engaging in a fixed income or fixed income impact investing, balancing financial goals with social and environmental objectives.